Axel, the dollar is strengthening. It keeps getting stronger. Now we look like we have a team beginning to form that will want a stronger dollar, and we have an OPEC agreement. What's to keep the dollar from continuing to strengthen?
What will keep it from continuing to strengthen? Well, maybe that reality is going to kick in, that some of these wonderful ideas are more difficult to implement. I mean, there are really two forces here. One is the spending Trump, right? He is going to promise somebody bridge to nowhere so he can build his wall. That some people say that's good, but that's inflationary, and it's not exactly budget discipline. I happen to think that yields go up in that case because of higher inflation expectations on the road. That's ultimately not good for the dollar. What is good for the dollar, if investment in the U.S. are made easier. So the GOP the plan to eliminate taxes on depreciation so that you don't have to, that you can depreciate your assets the first year, restructuring the U.S. tax system to foster investment rather than consumption, and you do that by not allowing to imports to be deducted and a few other things, and this depreciation rule. So those things are positives for the dollar. But all of this happens, of course, in the backdrop that a lot of good news is priced into the dollar already, and then historically the dollar goes up when there's an anticipation of higher rates, not when rates actually go higher. And I would like to caution people about making too many parallels to the early 80s, because in the early 80s, the situation was different. We had high unemployment, we had high inflation, and asset prices were much lower. And to just add one thing, the dollar is no longer the primary funding currency of choice. That's moved to the euro these days. So if you think that markets are not going to have smooth sailing, I wouldn't bet that the dollar is going to be the prime winner.
Well, and exactly. It's always, you know, in comparison with another currency. And of course, the euro has its own troubles right now, trading around 1.06. In fact, below 1.06 at the moment. And we have an Italian referendum on Sunday. What's going to be the outcome? Could we be facing a quit-Italy moment?
Well, what's interesting is that you don't see much stress in the market. I mean, you would think that the Italian referendum is likely going to fail. And so if there is such turmoil, why aren't treasuries rallying? Why are they falling? Why isn't the yen strengthening? And so there's a lot of complacency about that. Now, does that mean that maybe it's just an Italian problem? Maybe it's not going to spread. You do see it obviously in the weaker euro, but at the same time, those positions are quite extreme. And we're not at the end of the day yet. There might be some repositioning at the end of the day, and you have a little bit of a euro surge. If there's risk off, the dollar often rallies. So I wouldn't be surprised if there's a quote-unquote sell the news type of thing. If risk is off, that the dollar actually does rally. So I wouldn't necessarily put my bets on the euro moving either way here. If indeed they do get reforms done, well, fantastic. But in Europe, nothing ever gets done. Nothing ever gets done smoothly. So everything is a grinding process. And in many ways, we know how the playbook works. We know that the banking system won't collapse because the ECB can keep any banking system alive. And so in that sense, the market is just moving on and probably thinking, well, what's the next thing that the Italians might come up with? And by the way, the banking reform is possible. In Italy, it's just politically very, very difficult.
Axel, there's a great column by Mohammed El-Erian on the Bloomberg today talking about the messages to politicians from markets that we've seen in November and this big expectation of a shift away from central banks to fiscal policy. And you've talked a bit there about the fact that the dollar's been strengthening in anticipation of a lot of things coming. What sort of fallout do we see in the markets if these fiscal plans in the US and perhaps elsewhere don't materialize?
Well, fiscal plans are used very broadly by various people, and the challenge is if fiscal planning just means you're going to start building walls and fix potholes, then that's ultimately not the best thing that's going to happen for the currency long run, because you already have low unemployment. That means inflation is just going to go up. If fiscal plan at the same time means reducing barriers for investment by changing EPA regulation, by changing regulation of financial service industry and so forth, then that of course can be a positive. And in Europe, it's extremely difficult to institute structural reform, especially on a broad scale, and so Draghi is being biting out his teeth. In the meantime, we've seen that these monetary policies are really at their end. I think most people agree with that, and in that context, though, I don't see there's much easing possible in the Eurozone, which means that on a real basis, rates might have bottomed in the Eurozone as well, and I think the market is underestimating that. And in the US, it really depends on whether the Fed wants to get ahead of this. I don't see a Fed that wants to get ahead of inflation, and so I think that there might be a disconnect in the market that ultimately maybe rates are not, on a real basis, are not going to go up quite as much in the US as anticipated, and might not be going down as much in Europe as anticipated. So it's always in the context of where we are. But yes, if we don't have a structural reform, and maybe we get structural reform now in the US, then it's, the markets are going to have a rougher ride.
Interesting what you're saying about rates, because I want to take your eye to this chart, which shows what gold has been doing versus Treasury yields. Of course, the dollar's been moving in tandem with the 10-year Treasury yield. Gold, of course, moving the opposite way. And you've always had very interesting insights on gold. So I'm wondering where you think it goes from here, because two of the top forecasters, ABN, OCBC, see it dropping to 1,100 by the end of 2017.
Well, in recent months, gold has been very highly correlated to bonds, and those correlations are not stable. They tend to morph in and out. But yes, right now, gold is fixated on that, and a lot of good news is trumped in. It's the scenario priced in that real rates are going to go higher. And my view is that in a few weeks and months, when the details come in on the actual reforms, well, this might well get watered down, that yes, we have a rate hike coming up, but is the net rate hike then in March, or is it only in December? And a lot of that depends on what the market is going to do. So we continue to have this thing where the tail is wagging the dog. And similarly on the reform side, it's going to be much more difficult. You can't just get rid of the deductibility of imports without having a huge fuss by lobbyists. And so these things are going to be watered down. And this is in the context, again, where valuations are. And ultimately, I think we're going to morph from the gold investor that's focused very much on real rates to the one that's focused on diversification. I see volatility go up, risk assets are going to suffer in that, and gold historically does that well in that environment. But that's a different sort of investor. And yes, gold can suffer as we go through that transition.